Hello and welcome to the latest edition of 10 Minute ABS. This edition looks at the first half of 2023 in the Australian securitisation market. This video is to be watched in conjunction with our half-yearly update that was released last week and is available via the link in the email above and also in Westpac IQ.
Beginning with issuance and primary market activity. Over Q2, the Australian securitisation market saw a total of 13.4 billion issued across 21 public transactions. This volume is well above the 8.1 billion issued in the first quarter and is also well above the volume in the prior corresponding period that saw only 10.8 billion issued. In fact, this is the busiest Q2 seen since 2007. However, I would note these volumes recorded represent the public issuance observed. Consequently, there has been a large quantity of other issuance, more than normal, that does not fall into this category. Of the 13.4 billion issued in the second quarter, 8.7 billion was made up of residential mortgage-backed deals across 11 transactions, and a sizable 4.5 billion was in other receivables including auto, equipment, personal loan and buy now pay later receivables. Following the volume placed in Q2, 2023 public issuance has now reached 21.54 billion across 36 transactions. Unlike Q1, there was more of a skew to prime issuance over the second quarter with 3 ADI transactions, 2 prime non-bank and a non-resident deal. The banking sector saw a $1 billion capital relief trade from Suncorp in April, a funding-only deal from Great Southern Bank in early June and a $1 billion capital trade from HSBC most recently. Post the 30th of June, Bank of Queensland mandated for a transaction from their REDS program. Most notably, the underlying assets were originated by ME Bank. Despite the relatively strong showing from the banking sector, the non-bank sector continues to dominate, making up 82% of year-to-date issuance. In the other ABS market, a total of 4.5 billion was placed across 10 transactions in the second quarter, bringing 2023 issuance to $7.1 billion across 18 trades. This volume notably exceeding the total volume observed over the whole of 2022. Whilst there has been a good distribution across other product types, auto and equipment continue to dominate. Over the second quarter, the domestic market saw activity from Angle Auto Finance with their debut public issuance from their Panorama Auto Trust program, Humm Group with further issuance from the Flexi Commercial program, Metro Finance with the commercial auto trade, as well as other auto and equipment deals from Grow Finance, Pepper Money, Liberty Financial and Plenty Finance. Also over Q2 the market saw personal loan transactions from Now Finance and Society One, as well as a buy now pay later deal from Zip that featured a sizable 50% credit enhancement. Moving on to issuance margins and trading levels. As always, major bank senior unsecured is a good place to start when looking at RV. Q1 global market volatility following the demise of Silicon Valley Bank and the forced merger of UBS and Credit Suisse saw spreads pop wider, given the global uncertainty around the stability of the banking sector. However, this dissipated in the final week of March when ANZ tapped the senior unsecured market, notably the first senior unsecured to price globally following these events. Over April, global senior financial spreads tightened as macro volatility waned. 5-year senior finished the month in the low to mid-90 BIP area. The month of May opened with spreads moving wider in line with global levels, and we saw NAB launch its post-earnings benchmark deal, pricing $5.25 billion across 3- and 5-year maturities. Throughout June, senior and covered spreads experienced very little volatility, with the major bank FRN curve little changed. The senior curve flattened in the last week of June. At the beginning of the second half, indicative 5-year secondary levels are currently around 93 to 95 bips with primary around 5 basis points wider. Moving on to mortgage-backed spreads. The lack of ADI RMBS primary issuance in Q4 2023 meant that secondary levels were very much driven by moves in broader credit markets and the senior bank curve. This lack of benchmark MBS supply continued into 2023, with primary securitization markets finding it difficult to assess relative value in the initial trades of the year. This was demonstrated with the first prime deal of 2023, the Triton 23-1 transaction from Columbus Capital in early February. The senior long WALE Class A1 notes priced at BBSW plus 140 bips, which was well inside the original IOIs of 150 to 155 bips. Q2 was a relatively strong period for ADI issuance, with 3 transactions pricing from the regional and other bank sector. The first of these was from Suncorp in mid-April with Apollo 2023-1, that increased from an original 500 mil to 1 billion. The senior Class A notes of the upsized transaction priced at 1-month BBSW plus 130 bips, which was 5 bips inside the original 135 area IOI. This level was also 15 points inside the Progress deal that priced a month prior. Early June saw Great Southern Bank, formerly known as Credit Union Australia, price Harvey 2023-1. The senior Class A note landed at 1-month BBSW plus 130. This transaction was closely followed by HSBC's upsized Lion 2023-1. The senior Class A1 notes priced at BBSW plus 120, which was 5 bips inside the original 125 area IOI. Given the tighter pricing and the increased deal size, this was a solid result for spreads and sentiment. With 5-year senior unsecured benchmarks marked at around 100 bips at the time of pricing, and major bank MBS indicatively at around 110, this pricing point looked relatively cheap at 120. As it stands, the Australian securitisation market is still awaiting a major bank RMBS benchmark in 2023 to guide pricing. Whilst there was a very short glimmer of hope for a major bank issue from CBA's Medallion program in mid-June, it soon became apparent that this particular deal was in private placement format. As we are well aware, a major bank benchmark formalizes indicative secondary margins and is the starting point for relative value analysis. Further exacerbating the lack of major bank supply, secondary trading levels for major bank RMBS is becoming less reliable given a rapidly diminishing stock of major bank MBS outstanding. In the subordinated AAA notes, prime bank spreads finished 2022 with a 245-point print from MyState's Conquest transaction that priced in late December. The first prime deal of 2023, the Triton 23-1, featured 2 subordinated AAA tranches. As with the senior notes, guidance levels provided were more in line with closing levels in 2022, consequently pricing snapped tighter post-launch. Q2 saw the pricing of 3 ADI transactions with varying degrees of price disclosure down the structure. In April, the AB notes of Apollo 2023-1 priced in line with guidance at 230 bips. This level was 10 bips inside the equivalent tranche in the AMP transaction at the end of March. The subordinated notes of HSBC's Lion 2023 transaction were not available during the marketing process, however, the margins were disclosed at pricing. The dual-rated AB notes priced at 225 bips. As shown in the chart, current pricing levels remain amongst the widest margins for subordinated AAA in recent history. Further down the structure, in the subordinated tranches, prime AA-rated notes went from 315 at the end of 2022, moved into 300 in the first deal of the year, moved back out to 310 at the end of Q1 with AMP's Progress, and finished Q2 at 310 with Lion 23-1. Single A-rated notes went from 350 at the end of 22, moved into 330 in the first deal of the year, moved back out to 350 bips at the end of Q1 with Progress, and finished Q2 at 360 with Lion. BBB-rated notes went from 425 at the end of 2022, moved into 405 at the start of 2023, moved back out to 420 at the end of Q1 with Progress, and finished Q2 at 410 with Lion 23-1. Moving over to the non-conforming sector. 2023 has been an extremely busy time with 10 transactions completed, amounting to a total 7.4 billion. Initial pricing in mid-February saw spreads tighten on the longer tenor notes to the 165-point area, only to widen back to the 175-point level towards the end of March. Q2 saw a somewhat confusing picture with a number of deals completed featuring a large amount of pre-allocation and/or non-typical structures that distorted the RV comparison. Having previously placed a transaction in March, La Trobe's second offering for the year in May provided a useful spread comparison. The senior, short tenor notes priced at 1 month plus 115, which was inside the 125 area IOI, and the longer notes priced at 165, which was also inside the 175 area IOI. These levels represented a leg tighter for the non-conforming market. Combined with the upsize to 750 million, this was a strong result for the sector. The equivalent notes of the 23-1 priced at 125 and 175 respectively. It was a similar story down the structure with the subordinated AAA, A2 notes pricing at 250, 15 inside the IOI and the Class B through F price 10 to 15 tighter than IOIs.
In the interest of time, we'll stop the video there, but the full report can be found online and includes additional topics including arrears, prepayments, New Zealand market, the AOFM involvement, and the issuance log of the year to date. Any questions, please feel free to come through to me directly.